Biotech stocks are making headlines for their wild swings, huge gains, but also big risks. The question, are these stocks worth buying? The sector is full of potential but also uncertainty. One breakthrough can send a stock soaring. One failed trial can erase years of value. Today we'll break down 3 buzzworthy companies: APM Aptorum Group, NUWE Nuwellis Inc., and BRN's Barinthus Biotherapeutics. These aren't your typical blue chips. They're on the cutting edge of medicine, and their stocks reflect that volatility. We'll look at what they do, their recent performance, financials, and the catalysts and risks ahead. My goal isn't to give you a buy or sell signal, but to arm you with the info you need to make your own call. Let's dive in. Let's kick things off by taking a closer look at APM, Aptorum Group, a company that's been making waves in the biotech sector for its ambitious approach to tackling some of the world's most pressing health challenges. Aptorum is a clinical-stage biopharmaceutical company, which means they're not yet selling products to patients or doctors. Instead, their main focus is on research and development, especially in the fields of infectious diseases and metabolic disorders, areas where new treatments are desperately needed. Right now, you won't find any Aptorum products on pharmacy shelves. Their entire business is built on the hope that their research will lead to a breakthrough therapy, one that could change the game for patients and investors alike. Their pipeline is especially interesting. It features a novel anti-infective drug designed to combat antibiotic-resistant bacteria, a problem that's growing worldwide and threatening to make many current treatments obsolete. They're also working on an innovative obesity treatment, targeting a market that affects millions and continues to expand every year. The potential upside here is massive. If even one of their drug candidates makes it through clinical trials and gets approved, the company's stock could see explosive growth, rewarding early investors handsomely. But let's be clear, the risks are just as significant. Most drug candidates never make it to market. A single failed clinical trial or negative result can send the stock plummeting overnight, wiping out a big chunk of your investment. Financially, Aptorum is in what's called a cash burn phase. They're spending heavily on research, clinical trials, and regulatory filings, but they aren't bringing in meaningful revenue yet. This is typical for early-stage biotechs, but it means the company is constantly under pressure to fund its operations. To keep the lights on, Aptorum relies on raising new capital, often by issuing more shares or taking on debt. This process can dilute existing shareholders, making each share you own worth a little less, and it can also weigh on the stock price. For investors, the most important things to watch are the company's cash runway, how long they can operate before needing more money, and the progress of their clinical trials. A positive trial result can buy them time and investor confidence, while setbacks can force them to raise more cash under less favorable terms. If their cash runway is short, expect more dilution ahead. That means your stake in the company could shrink, even if the science is promising. In short, APM is a classic high-risk, high-reward play. The swings can be dramatic, both up and down, and it's not for the faint of heart. If you're a conservative investor who values stability and predictable returns, this is probably not the stock for you. The volatility and uncertainty are simply too high. On the other hand, if you're comfortable with speculation and can afford to take some losses, a small position in Aptorum could offer outsized rewards. Just be prepared for the possibility of losing your entire investment. Before you invest, do your homework. Dive deep into their drug pipeline, understand the science behind each candidate, and keep a close eye on their financial statements. The more you know, the better your chances of making an informed decision. Ultimately, investing in Aptorum is a binary bet. The outcome hinges on whether their research and development efforts succeed or fail. There's rarely any middle ground in this space. Think of it like buying a lottery ticket, but one where your odds can actually improve if you put in the work to understand the science and the business. The best approach? Only consider Aptorum as a tiny slice of a well-diversified portfolio. That way, even if things go south, your overall financial health won't be at risk. The potential rewards are enormous, but the path to success is narrow and filled with obstacles. Only a few companies in this space ever make it to the finish line. If you can't handle wild price swings and the stress of watching your investment value fluctuate dramatically, this probably isn't the right fit for you. but for those with a strong stomach and a taste for risk, Aptorum Group is a fascinating company to watch, and maybe, just maybe, a worthy addition to your speculative investments. Remember, never invest more than you can afford to lose, and always approach high-risk stocks with caution and a clear plan. Next up, let's talk about NUWE, Nuwellis Inc., a company that's quietly making waves in the medical device sector. Unlike APM, which is still in the early stages, NUWE is already commercializing its technology. They're a medical device company with real, tangible products on the market and, importantly, actual revenue coming in the door. This isn't just a story about potential, it's about a business that's already operating in hospitals today. Their flagship product, the Aqueduct SmartFlow system, is designed to help hospitals manage one of the most critical and costly problems: excess fluid in patients with heart or kidney issues. Fluid overload is a major challenge in healthcare, leading to longer hospital stays, higher costs, and worse outcomes for patients. Aqueduct offers a less invasive, more precise way to remove that excess fluid, which can be life-saving for many. What's clever about NUWE's business model is that it's not just about selling a device once. Each Aqueduct system placed in a hospital creates a recurring revenue stream because the system relies on disposable components that need to be replaced with every use. This means that as more hospitals adopt the technology, revenue can grow steadily over time. We're already seeing that growth in their financials. Revenue is trending upward quarter after quarter, but like many young medtech companies, they're not profitable yet. The costs of scaling up, hiring sales teams, supporting clinical trials, and expanding manufacturing are significant. NUWE is investing heavily in both sales and research and development. Their goal is to drive adoption in more hospitals, while also improving and expanding their product line. This dual focus is critical. Sales growth brings in revenue, while R&D ensures they stay ahead of competitors and meet evolving clinical needs. The big question for investors is whether NUWE can scale fast enough to reach profitability before their cash reserves run out. It's a race. Can they grow revenue and control costs quickly enough, or will they need to raise more money, potentially diluting shareholders? The opportunity, though, is massive. Heart failure and fluid overload are not niche problems. They're among the most common and expensive conditions treated in hospitals worldwide. As populations age and chronic diseases become more prevalent, the need for better fluid management solutions will only increase. NUWE isn't stopping with adult patients. They're expanding into new clinical areas like pediatrics and critical care, where fluid management is just as vital. These new markets could significantly boost their growth trajectory if adoption takes off. But as with any innovation, there are risks. Competition in the medical device space is fierce, with established players and new entrants constantly vying for hospital budgets. And changing hospital purchasing habits is notoriously slow. Administrative processes, clinical trials, and staff training all take time. Another challenge is reimbursement. Hospitals need to know that insurers will pay for new treatments and devices. Navigating the complex world of insurance claims and approvals can be a major hurdle for any medtech company. Like many companies in growth mode, NUWE is burning through cash to fund expansion. If they need to raise more capital, existing shareholders could see their stakes diluted. This is a common risk in the sector, but it's something to watch closely. For investors, the key metrics to watch are revenue growth, improvements in profit margins, and the rate at which hospitals are adopting Aqueducts. These will tell you whether the company is on track to become a leader in its field. If NUWE can establish Aqueducts as the standard of care for fluid management, the upside could be significant. Widespread adoption would mean recurring revenue, stronger margins, and a defensible market position. But if adoption stalls, or if the company runs low on cash before reaching profitability, the stock could face serious headwinds. It's a classic high-reward, high-risk scenario. Compared to a pre-revenue biotech, NUWE is less risky because it already has products and revenue. But make no mistake, it's still a speculative investment with plenty of uncertainty ahead. This is a long-term story. Investors will need patience as the company works to expand adoption, improve margins, and navigate the challenges of the healthcare industry. If you believe in NUWE's technology, management, and ability to execute, it could be a compelling addition to a moderate-risk portfolio. The potential rewards are real, but so are the risks. Keep a close eye on their financial health, market traction, and any updates on reimbursement or regulatory approvals. These factors will shape the company's future. Ultimately, execution is everything. Nuwellis' ability to deliver on its promises will determine whether it becomes a medtech success story or just another ambitious startup. Finally, we arrive at Barinthus Biotherapeutics, or BRNs, a company that's quietly making waves in the world of next-generation medicine. While it may not be a household name yet, its ambitions are anything but small. BRNs is a clinical-stage biotech company, but what sets it apart is its laser focus on T-cell immunotherapies. These are cutting-edge treatments designed to harness the body's own immune system, specifically T-cells, to target and destroy disease. Their technology is all about training the immune system to recognize and attack chronic infections and cancer cells. These are two of the most challenging and costly health problems facing humanity today, and the potential market is enormous. BRNS's lead programs are focused on chronic hepatitis B, a stubborn viral infection that affects millions worldwide, and a range of cancers, including some of the most difficult to treat. If they succeed, the impact could be nothing short of revolutionary. A breakthrough in either area would not only transform patient lives, but could also reshape the entire biotech landscape. Of course, the upside is massive, but the path is anything but straightforward. The science behind T-cell therapies is incredibly complex, involving intricate genetic engineering and a deep understanding of immunology. The risks are high, and the margin for error is slim. Many companies have tried and failed to bring similar therapies to market. Clinical setbacks, unexpected side effects, and regulatory hurdles are all too common in this space. But BRNs isn't putting all its eggs in one basket. The company has a diversified pipeline with multiple programs in development. This approach helps spread risk and increases the chances that at least one therapy will make it through the gauntlet of clinical trials. Still, setbacks are almost inevitable. Failed trials, disappointing data, or even shifts in regulatory policy can derail years of work and millions in investment. Financially, BRNs is in the classic biotech position, burning through cash as it funds research and development with no profits in sight. This means the company is dependent on raising new capital or forming partnerships to keep the lights on. That's where partnerships with big pharmaceutical companies come in. These alliances can provide not just funding, but also validation of BRNs' science and access to resources that a small biotech simply can't match. For investors, the key catalysts to watch are clinical trial results and partnership announcements. Positive data or a new collaboration can send the stock soaring overnight. These events can trigger dramatic moves in the stock price, both up and down, making BRNs a volatile but potentially rewarding play. The investment case for BRNs is clear. If you believe in the promise of their science and see potential in their pipeline, this could be a high-risk, high-reward opportunity. The upside is enormous if even one program succeeds, but the bear case is just as strong. Drug development is notoriously uncertain, the company's cash burn is high, and competition from other biotechs and big pharma is fierce. Many promising drugs never make it to market. If you're considering an investment, it's essential to do your homework. Dive deep into their clinical trial designs, understand the underlying technology, and keep an eye on the competitive landscape. Volatility is the norm here, not the exception. Only invest what you can afford to lose. This is not the place for your emergency fund or retirement savings. For the right investor, BRNs could be a small, speculative addition to a well-diversified portfolio, an exciting but risky bet on the future of medicine. Always assess the quality of management, the company's cash runway, and the strength of its partnerships. These factors can provide a margin of safety in an otherwise risky sector. The potential for BRNs is world-changing. If their therapies work, they could save countless lives and create enormous value. But the risks are real, and failure is always a possibility. So approach with caution, do your due diligence, and remember, in biotech, hope and hype can move markets, but only real results create lasting value. To sum up, APM is a high-risk bet on drug breakthroughs. NUWE is a commercial-stage device company betting on adoption. BRNs is a speculative play on T-cell immunotherapy. All three offer big potential and big risks. This isn't financial advice. Biotech is volatile. Never invest more than you can lose. Do your own research, read filings, listen to calls, and consider your risk tolerance. If you found this helpful, hit like and subscribe for more deep dives. Drop your thoughts or stock suggestions in the comments. I read them all. Thanks for watching and see you in the next video.